Hey everybody, Steve Burton here at Scale to Sell. Welcome back as we talk to you business owners today. Episode 33, we're going to be talking about the difference between tax preparing and tax planning. Taxes are a big part of businesses and try to mitigate and bring those costs down. And if you go to sell the business, how do we mitigate that too? We've got a teammate of ours, at Scale to Sell, we try to be a one-stop shop. As far as I'm a financial advisor, we've got tax planners, we got corporate attorneys, we got estate attorneys. We try to make it, we got marketing teams. We have all kinds of people to help grow or exit that business. Today, we're going to welcome Blake Schaper into the call. And Blake, welcome to the Scale to Sell podcast.
Hey, Steve. Thanks for having me.
No worries, no worries. A little bit about your background for those people that may not have heard my radio shows or come in contact with us. Just a little bit about your background, and then we'll get into the topic today.
Yeah, perfect. I'm a CPA that has focused my entire career alongside a much larger team than just I of CPAs and attorneys that focuses on helping business owners scale their business in a tax efficient manner and prep that business for an eventual sale. We've worked with families across the country, high net worth, ultra high net worth, folks that are just getting started to folks that own football teams, NFL football teams. So a pretty large variety there. I spent about 13 years in the military, flying helicopters for the Army, transitioned into tax, which you probably haven't heard that very often, pretty odd transition. But what I really liked about what I'm now doing full time is this idea of being proactive, of putting plans together. And although it's much different, Steve, and I've talked to you about this, than what I did in the past, the idea in the military of planning is really embedded into everything that we do. And this is just a different flavor of that. How do we proactively plan for things we know are going to happen, a business sale, a business purchase, growing a business, whatever it may be, or maybe passing it down to the next generation in a way that's tax efficient. So this is just a different flavor, if you will, of this idea of planning that I've been doing my entire career.
Myself, I own about 5 businesses still. I've owned a few dozen over my career or whatever. And so we've used an accountant to back up our my wife, who's done most of the bookkeeping for our businesses. And I assume that just because the IRS doesn't send me nasty letters or they don't show up on my doorstep, I assumed that we were doing everything right. But that assumption, I've now learned, is maybe cost me tens of thousands, perhaps even hundreds of thousands of dollars per year. And I can only imagine what it could be over 10, 20, 30 years. But you're seeing that a lot. There's a lot of CPAs, accountants, enrolled agents that they're filling out boxes and they're really not thinking ahead. They're not playing, I call it financial chess, thinking about next year or 5 years. So a little bit about what's the difference between tax planning and tax preparing.
Yeah, Steve, I know you see this all the time, as do I. The CPA industry and the tax industry at large is really built around this idea of churning out tax returns. If you talk to most CPA firms, they measure success based off of how many returns they did that year, which is a terrible metric if you're really looking at trying to improve a client's plan. Because tax preparation is nothing more than a reactive drill. It's putting numbers in boxes, like you said, Steve, and sending them off to Uncle Sam and making sure everything's in compliance, which is obviously important, but that's not what creates tax efficiency, to your earlier statement there. What creates tax efficiency is this idea of proactive planning. It's looking ahead. It's focusing on what might be coming down the pike from a legislation standpoint, what might be coming down the pike from a goals and objectives standpoint of the client or the needs thereof, whether it's business related or personal related, and then crafting a plan around that. And in particular, a plan that is synchronized with their financial plan, a plan that's synchronized with their estate, their insurance plan. So it's not just this idea of being proactive. It's this idea of being proactive and planning in a way that is synchronized with all the other aspects of the plan. And you said it best earlier, Steve, this idea of a one-stop shop. That's so critically important to this concept of planning and integration. But at the core, to answer your question, Tax preparation, reactive. Compliance, that's it. Tax planning is this idea of creating tax efficiency and hopefully mitigating what you pay Uncle Sam. And a lot of times, Steve, it's just by paying attention. You and I have talked a lot about that. That's my view of the difference there between those two.
No, I 100% agree. You're talking about you talking about somebody that owns NFL teams, somebody ultra wealthy, billionaire types. And a lot of these types of businesses, they have people on their team, tax planners, they maybe even tax attorneys, and they have everybody, financial advisors, they have everybody working all in on that one plan instead of having everyone working in different directions. How important is that to have a team all working in the same direction?
It's a great point. We see it even with these large families, like you said, Steve, or companies even that have a lot of these embedded resources. Is you can have a lot of resources, but if everyone's not rowing in the same direction, you end up with either a bunch of different plans that are not working together or plans at worst that are in conflict with one another. The idea of everyone in the same boat, communicating effectively internally, all on the same team, creates a lot of efficiency in how all these various plans interlock into one comprehensive plan across tax and investment and insurance, so that everyone's rowing in the same direction and we're building a plan that knows the ins and outs of all the other considerations outside of, let's say, the domain of tax or law. It's all interwoven and integrated.
You mentioned the rowing in one direction and brought flashback memories to me. Me and my wife were at a conference down, I think it's in Puerto Rico, and we were out one night and they took us out to this little bay thing, and we were in a canoe, and she was rowing in one direction, I was rowing in another, and we weren't going anywhere but in circles. And I had that flashback really quickly about that. I eventually asked her to put her paddle down, and I did the rowing from there on out, and wore me out, but it was good stuff. But in the larger people, they have this. What we're trying to do is bring this down to all business, small, businesses that may be doing $500,000, million, $5 million, $10 million a year, all the way up to 100 million plus. Because again, most of them don't have that. Just because your tax people keep you on the straight and narrow, as I mentioned earlier, you don't get nasty notes. I assume wrong, but let's talk about that person. We talk about measuring your value. And if you don't know the value of your business, you can go to scale2sell.com/value, scale2sell.com/value, and free of charge. You should have that done like you'd get a checkup for your teeth or your physical every year. You should have your business evaluated. But let's talk about if we're trying to grow that value, Blake, if you're saving, if you have an opportunity to bring those taxes down, that improves that value, because if you're saving them even modest sums of money, maybe it's 50,000, perhaps in some cases could it be even more than that, times a multiple of 4 or 5, whatever that business might be selling for eventually. It increases the value without having to come out of pocket, but just a little bit. The return on the investment is quite large, or could be.
Yeah, you're spot on, Steve. I mean, the way we measure success here is what is actually left in the business owner's pocket when they sell the business and pay Uncle Sam, the focus is often on, well, what's the gross amount that the owner's given, which is also the focus of investments. You hear it today. Well, I got 7% or 8 or 10%. The real question is, what was in your pocket from a percentage standpoint after all things were taken out? And it's the same concept with selling the business. And it goes back to this idea of being proactive and staging, as I like to say, the business for sale, almost like you're staging a house that you're moving out of and selling. You're getting pictures made, you're making sure everything's buttoned up, repairs, etc. And you're making sure that it has the highest value it possibly can on the market prior to putting it on the market. And it's not much different, to your earlier point, with a business. What can we do to understand what the business is worth today? What can we do from a tax standpoint, from an operations standpoint, to improve the value just by paying attention to those things that are often overlooked? Things that, if you have certain standards or procedures, or you're doing something a certain way from a tax standpoint, will increase your multiple, your valuation, and your exit just because you put them in place prior to selling it. So all this centers on this idea of taking enough time. And this is the real struggle I see with business owners. They're always 100 miles an hour, pedal to the floor, building that business. And a lot of them will fail to stop long enough to focus on nurturing the perception and efficiency of their business from the point of view of a sale. They won't stop to figure out what it's worth. They won't stop to focus on how to improve that because they're just trying to generate as much income. And oftentimes that bites them on the backside of this because they end up paying either a lot more in taxes or they don't get as much from a valuation standpoint. So it all comes full circle. So my advocation to business owners across the nation, I know it's yours, Steve, proactively preparing for a sale. You want to scale it like you've said, and then you want to stage the house. I'm sorry, I'm being long-winded.
No, that's perfect. We talk about on the different podcasts, growing the value. Well, knowing the value first. Most business owners don't know the value, the true value. They think, they guess, they've heard it through a buddy in the similar industry, but they really don't know what their business is valued at that year. At least once a year. Again, scaletosell.com/value. Let's talk a little bit. So we're talking about the people that are actively working, trying to keep more money in their pocket and or improving the value of the business. I was talking to somebody recently, a client of mine, and we're doing a lot of things with their business. We're helping out with their 401k, employee benefits. We're doing workplace education. We're improving the value of the business. At some point in time, about 5 years from now, is his target. He's got a son in the business that that is interested in taking over the business. It's worth tens of millions of dollars, and it could eventually be worth $100 million. And his concern was, he brought this up multiple times, and just the other day, how do he mitigate, whether he sells it to his son or whether he sells it to somebody else? How does he mitigate taxes in the future? And you don't wait till that moment in time. I don't think, Blake, I would think that you would start tax strategies now.
Yeah.
For a sale and exit in 3, 4, 5 years, or perhaps even longer. What do you see, or what can you bring to the conversation there? You don't wait till the last second, I think would be a good idea.
Yeah, I mean, to use an aviation metaphor, since that is my prior background, you want to leave yourself enough runway to plan and prep prior to departing from the business. A minimum of a year. I'm not saying it can't be done in shorter, but what you often sacrifice when you cut out a portion of that runway is options. You sacrifice the ability to do things that may create tax efficiency because you just don't have enough time to put those things in place prior to a sale. The cardinal sin in this arena is waiting until an offer's on the table to start planning. Because at that point, the majority of your options from a planning standpoint are just out the window. There might still be some things you can do, and you should look at those. But by and large, you've cut down a list of, however many options. Let's say it's 20 options down to maybe 2 or 3. So don't put yourself in that situation. And again, that's the struggle with most business owners, is pumping the brakes just enough to start that focus a few years in advance. Now, going back to what you were saying earlier, Steve, what do we look at when it comes to a business that's going to be passed down to the next generation, or maybe sold to the kids or to an external party? There's various things, and it all circles on how we mitigate tax at a comprehensive level. It's not just mitigating capital gain tax. It's mitigating how much is recognized as ordinary income. A lot of times when you sell a business, you have depreciation recapture. So how do we make sure we balance that and make as much as possible capital gain? But also for those large businesses, how do we make sure it's not hit with an estate tax, which is pretty dang large at 40% essentially, and 40 cents on the dollar going to Uncle Sam when you pass away, or if you gift something down to the next generation, eating up your unified credit. That's a lot. That's a huge amount. So if we can pay attention to both mitigating capital gain tax, preventing ordinary income as much as we can being recaptured, and then also how all this passes down to the next generation, whether it's the actual business passing down, or maybe it's the proceeds from the sale of the business to some external party that are eventually going to be passed down to the next generation. The designations on my screen, that last one, the CTFA, the T stands for trusts, And that's an important part of estate planning. And a lot of times, how we can mitigate the taxes associated with what's passed down to the next generation, but also protect those things that are passed down. You and I have talked a lot about that, Steve, not to derail the convo. Yeah, that's my thoughts there.
Let's talk about some, one other thing, and I don't think I had thought about this before. So we're primarily talking to business owners here at Scale to Sell. We do work with a lot of individuals as well. But business owners today, we're trying to mitigate your taxes throughout the year. You work really hard in this business and you think you've got a great CPA or an accountant enrolled agent, and they may be doing a great job, but how much money could be left on the table? Or perhaps you're looking at exiting the business. I have owners all the time. We've said it here on the calls before. I've had business owners say, "Well, I'm never gonna retire." Well, you will not keep the business forever because you're not gonna live forever. So you need to have a
Right.
game plan for those future taxes. So tax planning into the future to include estate planning as well. But other thing I thought about, Blake, is that your team right there on the tax side of what we do. We're a financial services company. I'm a financial advisor. I have an advisory firm. I sell life insurance and annuities and anything financial on that end of it we work with. But as part of your team and a part of the association with your team, you guys are acquiring accounting firms across the country, and you're looking out there. So if we got an accounting firm right now and they're doing primarily tax returns and maybe books and whatever else it might be, but would like to add tax planning to the conversation, they can get a hold of us at scaletosell.com/discovery, and we will get them in contact. But a little bit about, what you're trying to do, your mission out there. And a lot of these people, maybe they're getting closer to retirement and are looking to exit them own selves. But a little bit about the growth of, your team right there and what you guys are looking for.
Yeah. Well, as it pertains, Steve, to the acquisition of CPA firms, we're trying to change the industry because the landscape's changing, whether or not CPAs want it to. And that's technology is becoming more and more efficient. And as we fast forward over the next 5 to 10 years, a lot of what we consider tax prep today, I believe, is going to be even more automated than it currently is. With artificial intelligence and just the efficiency of technology, you're going to have a lot of that button pushing no longer done by a human, which forces our industry to really start focusing on advisory services. How do we do the planning that I've been talking about and you've been talking about on this call? So our mission is to find CPA firms that are looking for an exit strategy, that are aligned to this idea of differentiating their service offering and really leaning into this part of the tax world that creates efficiency for their clients. It's not just good for their clients, it's good business because of the way the industry is changing and technology is changing. So that's what we're doing, and our goal there is to acquire firms across the country. We've acquired some up to this point, and really differentiating and educating and rolling out these advisory services that we're talking about today, Steve.
And it doesn't necessarily have to be a full acquisition. Sometimes you're doing relationships where you're buying in
Yeah.
part of the business, looking to grow value right there, and they may hold on to their percentage of ownership forever and a week, or at some point build up. You guys help them build up value, and they have another exit, a full exit, at some point in the future. I think you're doing that as well.
Yeah, absolutely. And it's funny you say build up value because that's what we were talking about earlier in a more general sense, but that's exactly what we're doing at the CPA firm level as well. How do we build up value by differentiating services, making the services more effective to the client, and being cognizant of these changes technologically that I was talking about earlier? So, yeah, you're spot on.
I would tell you a lot of you right now, I've said it in my seminars, my radio shows, right now, a lot of you are getting your taxes prepared for last year. Your accountants, EPA, enrolled agent, whoever's doing your taxes, perhaps somebody in your office, they're filling out and checking boxes, but are they taking advantage of every opportunity right there? So it's not too late to get started, even for right here, right now. I think the greater value is in the years to come, though, and what can be done to build that value in that relationship. Blake, we are running down on time. We try to keep these things about 20 minutes or so. Any final thoughts here, and we'll go through and how they can get in contact with us, and we in turn will put them in contact with you. A lot of times business owners come to me and we sit down and I will mention them, Blake and his team, and they'll want to have a conversation. In fact, so many people reached out to us. We recorded a video for business owners, but we kind of went through a lot of that today. So I don't know that you need that video, but Blake, any final thoughts about tax planning versus just tax preparing?
Nothing that's not already been said. I think a closing thought would be that, the type of clients that we want to work with are folks that care about their business, which sounds silly to say, but caring about your business is more than just trying to make it profitable. It's enhancing value. It's being disciplined enough to pump the brakes and focused on what improvements can be made to ensure there's a tax efficient exit, there's a succession plan, your estate plan is aligned with that, and everything that you said, Steve, is synchronized. And those are the type of folks that we're looking for, and that's where I believe we collectively, Steve's team and us being embedded into that, can provide the highest value. So that's it, Steve. Thanks for having me.
Absolutely. Hey, guys, you got to know your value before you can grow your value, in my opinion. Know your value at least annually. We can go to Scale Discovery or just reach out there on their website at scaletosell.com. Blake Schaper, we appreciate you.
Thank you for listening to Scale to Sell with Adam Burton and Steve Burton. Click the follow button to be notified when new episodes become available. Visit our website at www.scaletosell.com or give us a call at 757-313-4080. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Scale to Sell. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing, tax, legal, or other advice. Always seek the advice of your financial advisor or other qualified professionals with any questions you may have regarding your personal or professional plans. Prior results do not guarantee a similar outcome.